Welcome to Iron Financial. This is the place where we forge stronger portfolios, and we do it by stress testing the market's biggest names. Today, we've got a titan under the microscope, Nike. They just dropped their Q3 earnings, and if you just glanced at the headlines, it looked like a win. But the market's reaction, it was absolutely brutal. Now that disconnect, that's a huge warning sign. So today, we are going to tear this report apart, piece by piece, to figure out if Nike's foundation is actually solid or if we're looking at the very beginning of a catastrophic structural failure. Let's get to work.
Yeah, let's be really clear about what we're talking about here. Nike isn't just another company on the S&P 500, it's a cultural institution. That swoosh, it's a global symbol of victory, of greatness. For decades, owning Nike stock was just a cornerstone of any serious portfolio. It was what you'd call a set-it-and-forget-it blue chip. But that story, well, it feels like it's changing. The whispers about a turnaround plan are definitely getting louder. You can see the sales are slowing down. And the competition? It is relentless. So the question for every single investor out there is pretty simple. Is this a champion just catching its breath between rounds, or are we witnessing the first real deep cracks in the armor? This earnings report is our first chance to get a good look under the hood and see what's really going on.
Okay, let's drill right down to the core of the issue. On the surface, you see a headline, and it's screaming victory, right? Nike beats estimates. They cleared the bar that Wall Street set for them. But the market, and let's be honest, the market is the only judge that truly matters, it rendered a completely different verdict. The stock sold off hard, almost immediately in after-hours trading. This is the central contradiction we're digging into, what we're calling the Nike paradox. See, when a company wins but its stock gets hammered anyway, that is a massive flashing red flag. It means the headline numbers are a facade. They're just papering over some serious weakness. The market is smelling foundational decay. And so are we. Exactly. That is the entire point of this analysis today. What is the market seeing that the headlines are conveniently missing? What are those stress points, the weak joints, that this so-called good news is trying to plaster over? Look, it's easy to be fooled by a simple number, but here at Iron Financial, our job is to take the sledgehammer to the drywall and actually inspect the support beams. What are the cracks in the foundation that have the smart money running for the exits? That is the question we're here to answer. So here's exactly how we're going to conduct this structural stress test. First, we'll dive deep into the paradox itself, those surface-level numbers that look pretty good. Second, we are going to deconstruct the revenue. Really break it down by sales channel to find the hidden weak points. Third, and this is absolutely crucial, we're going to analyze the margin meltdown, the corrosion of their profitability. Fourth, we'll look for cracks in the empire, and we'll do that by examining their performance across the globe. And finally, we'll assemble all of the evidence and deliver our final verdict. Is Nike's framework still sound, or is this just a trap for unwary investors?
All right, section 1, the paradox. Let's start with the numbers that created this whole illusion of strength, the ones that were designed to make you feel comfortable and keep buying. Top-line revenue came in at $11.28 billion. The Wall Street estimate was just a hair lower, $11.24 billion, so technically that's a beat. Then you have earnings per share, or EPS. Nike delivered 35 cents when the analysts were only expecting 31, so again, a beat. If you stopped reading right there, you'd think this was a story of a company just firing on all cylinders. But that, right there, is the trap.
Whoa, hold on. Let's rip that apart right now. A beat is completely meaningless if the bar is sitting on the floor. And look at the most important number on this entire slide. Total revenue growth flat. Zero. Zilch. A Goliath like Nike is supposed to be a growth engine, not a car that's stalled out on the highway. So they barely squeaked by an already low estimate. They delivered literally zero growth, and the market still punished the stock, sending it down over 3%. That doesn't smell like strength. That's the market screaming at you that even mediocrity wasn't good enough. And that is the perfect transition into our second section. To really understand the market's negative reaction, we have to look past that flat $11.3 billion number and deconstruct it. Think about it. A building's facade can look perfect from the street, but you have to go up close and inspect the individual bricks and the mortar to find the decay. For Nike, that means breaking down their revenue by how they sell their products. And this, my friends, is where the first major structural fissure appears. For years, Nike's entire corporate strategy has revolved around one central idea: Nike Direct. The plan was to cut out the middlemen, the Foot Lockers of the world, and sell directly to consumers on your own website and in your own stores. And why would they do that? Because that's where the high margins are. That's the most profitable sale you can possibly make. It gives you total control over your brand image, your pricing, everything. But just look at what's happening. The strategy is failing. Nike Direct revenue, the most important part of their business, is down 4%. Meanwhile, their lower margin wholesale revenue, selling to other retailers, is up 5%. They are becoming more reliant on the very channel they were desperately trying to escape. Their entire strategy is moving in reverse. Let me be blunt about what this really means. This is a critical failure of their core strategy. We're not talking about a small misstep. Digital sales, the engine of all modern retail, are down a shocking 9%. Customers are just not going to Nike.com. And their own physical stores, they're doing just as badly, with sales down 5%. This is forcing them back into the arms of their wholesale partners, where they have to surrender a bigger cut of every single sale. They aren't just becoming less profitable, they are being forced to abandon their own strategy because it is simply not working. And if you thought the Nike Direct numbers were a crack in the foundation, this next number is a wrecking ball. Negative 35%. That is the catastrophic year-over-year revenue collapse of their subsidiary brand, Converse. We are talking about a drop from $405 million just last year to only $264 million this quarter. This isn't a slowdown, this isn't a soft patch, this is a complete implosion of a major brand that sits right under their corporate umbrella. This right here, this just obliterates any simple, happy turnaround story you might hear. How can you possibly claim your foundation is getting stronger when a whole pillar of your business, a globally recognized brand like Converse, is crumbling by over a third? And the earnings report states this explicitly. This was due to declines across all territories. So it's not just one bad region, it's a global rejection of the brand right now. This is a massive, uncontained fire raging within the Nike portfolio, and it raises some very serious questions about management's ability to handle their assets. The revenue picture is deeply troubling, for sure, but revenue weakness alone doesn't usually sink a company. The real damage to structural integrity, the one thing that can bring the whole building down, is a collapse in profitability. This is where the foundation truly begins to corrode. So let's move to our third section, the margin meltdown. This is where we analyze how much money Nike is actually making from the sales they generate. This table right here, this is the engine room of the bear case against Nike. Let's just trace the decay. Start at the top. Gross margin fell by 130 basis points, that's 1.3 percentage points, down to 40.2%. So for every $100 of product they sold, they're now making $1.30 less than they did last year. Now, just watch how that poison drips down the entire income statement. Income before taxes plummets 23%. Then you get the final blow, net income, a catastrophic collapse of 35%, from nearly $800 million down to just $520 million. You have flat revenue at the top, and a 35% collapse in profit at the bottom. That is not just a leak, that is a structural breach. So the company's official reason for this gross margin hit is higher tariffs in North America. They're blaming external factors. But here's the tough question for you as an investor. Is your business model so fragile that tariffs can wipe out over a third of your net income in a single year? A strong company, a truly resilient structure, it should be able to absorb or mitigate those kinds of pressures. A 35% drop in net profit is not a flesh wound, it's a gaping chest wound. It suggests the business lacks the pricing power or the operational efficiency to handle even a little bit of adversity.
And the pressure isn't just coming from one direction. The corrosion is happening everywhere. While their gross margins were shrinking, their costs were actually rising. Selling and administrative expenses went up 2% to a massive $4 billion. Operating overhead went up 3%, and they said that's partly due to severance costs from layoffs. Never a good sign. And then look at the tax rate. It more than tripled, jumping from just under 6% last year to 20% this year. This is a perfect storm. The money coming in the door from sales is less profitable, the costs to run the business are going up, and the government is taking a much bigger piece of what's already a shrinking pie. Every single lever of profitability is moving in the wrong direction.
Okay, so we've established that the revenue strategy is backfiring and the profitability is collapsing. Now, let's look at the map. A global empire like Nike needs all of its territories to be strong, or at the very least, stable. But this weakness isn't uniform. When you conduct a geographic stress test, you find that some of the most important pillars of the empire are starting to crumble. And that's exactly what we're going to cover here in Section 4. Let's break down the global empire piece by piece. North America, their home turf and their biggest market, is holding the line with about 3% growth. Honestly, that's the only good news on this entire map, and it feels like it's being used to mask the decay that's happening everywhere else. Europe, the Middle East and Africa, EMEA, it looks like it grew 2%, but if you dig into the fine print, you find the truth. On a currency-neutral basis, it actually fell by 7%. Asia Pacific and Latin America is basically stagnant, up only 1%. But the real five-alarm fire is that third pillar, Greater China. And there it is, a 7% decline. For years, the bull case for Nike was built on the foundation of explosive growth in China. It was supposed to be their next great engine. You had a middle class of hundreds of millions of people, and the story was they all wanted to wear the swoosh. Instead, it's become their biggest liability. This isn't just a number. It represents a fundamental failure to connect with the modern Chinese consumer, especially when they're facing fierce local competition from brands like Anta and Li Ning, who are just eating their lunch over there. And this is the most critical point. I really want to deliver this with emphasis so it sinks in. This is the 7th straight quarter of declining revenue in Greater China. This is not a blip. This is not a one-off problem from a bad product launch or a weird quarter. This is a nearly 2-year trend of systemic decay in what was supposed to be their most important growth market. A foundation doesn't just crack overnight, it erodes over time. And what we are witnessing here is a long, painful erosion of Nike's position in China.
All right, that brings us to our final section. It is time to assemble all the evidence from our stress test. We've looked at the flawed revenue mix, the collapsing profitability, and the geographic decay. Now we have to answer that initial paradox. Why did a stock that beat estimates fall so hard? It is time to render a verdict on the structural integrity of Nike.
You just have to listen to the language coming from management. The CEO, Elliott Hill, he says, "Our foundation is getting even stronger." Let me ask you a question. How can a foundation possibly be getting stronger when your net income has collapsed by 35%? How is it getting stronger when your high-margin direct-to-consumer business is actively shrinking? How is it getting stronger with the 7th consecutive quarter of decline in your key growth market? The data we've just reviewed completely contradicts this statement. This is corporate speak. It's designed to soothe you, not to inform you.
So, the verdict from our stress test is crystal clear. The market's negative reaction was absolutely justified. Let's just summarize the key findings. First, that earnings beat was a hollow victory. It was achieved by clearing a very low bar that was only set because everyone already knew the business was struggling. Second, the flat revenue number hides a toxic mix, with a dangerous decline in the high-margin direct sales that are so critical for long-term health. Third, profitability isn't just weakening, it is collapsing under a multi-front assault from lower margins and higher costs. And fourth, the decay in key international markets, especially that 7-quarter losing streak in China, points to a long-term systemic problem, not some short-term issue.
And the crucial point is this. The market did its own stress test in a matter of seconds. It looked right past the flimsy headline beat. It saw the collapsing margins, the reverse strategy, the absolute disaster in China, and it sold the stock. The market concluded that this is not a solid foundation to build on right now. Investing in a turnaround story before the heavy lifting of fixing these deep-seated issues is truly done, that is a massive risk. You are betting on hope, not on evidence, and the evidence today points to a structure with significant, undeniable cracks.
Which leaves us with the final question for you, the investor. As you forge your own portfolio, you have to decide, is Nike's turnaround plan building on a solid foundation that can actually withstand these pressures, or are they just rearranging furniture inside a house of cards? Look past the headlines. Do your own stress test. That's how you build a portfolio of iron. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.